Well, good morning, everyone. My name is John Paul Ruiz, Director of Professional Development here at the Entrust Group, and we appreciate you attending today's webinar entitled Leaving a Legacy with a Self-Directed IRA. One of the reasons why we decided to come up with a webinar such as this one is that assets in retirement plans are dramatically accumulating, and individuals are, of course, getting older every year. And a lot of the questions that we've been receiving involves what happens to my retirement plan assets that I've worked so hard to accumulate? What happens when I die? Thus the title, Leaving a Legacy with a Self-Directed IRA, or for all intents and purposes, any sort of retirement plan. Again, my name is John Paul Ruiz, Director of Professional Development. What we will cover in today's seminar is what's built into law. What does the law say happens to the assets of an individual's account in a retirement plan which has been tax deferred? In other words, in a bubble in itself that has not been taxed or allowing for it to grow with postponement of taxation on the interest and the earnings of particular investments. What happens to those assets upon the death of the retirement plan holder? Well, the good news is there's actually rules that are in place within the document of a retirement plan that specifies what the options are for beneficiaries, and that will be one of the main focus of today's seminar, so that not only do you, the retirement plan holder, knows what happens to those assets, that you may also be able to convey that message to the beneficiaries that you have named in your retirement plan, so that when you pass away, that they are aware of what their options are. Now, a little bit about the Entrust Group before we proceed, a little bit of a disclaimer here. The Entrust Group is a record keeper. In other words, we offer a platform that allows for individuals to put in non-traditional types of investments under their retirement plan, because we really don't offer any investments. Again, the Entrust Group is just a vehicle, or it's just an entity that allows taxpayers who have retirement plans to have their assets be held at a financial institution that would allow for such investments to be held under their platform. With that said, the Entrust Group does not provide investment advice nor endorse any products. But what we do heavily is educate the community in regards to what can be held under a retirement plan, because we have no vested interest in any sort of investment because we don't offer any. But we do have a vested interest in educating the public to make sure that they understand what is available in retirement plans, as well as what the options are available according to law. All the information that's going to be covered in this particular webinar are purely for educational purposes only. We always reserve the right, I'll tell my attendees, you always reserve the right to research what we presented to you. And we will direct you to certain parts of the law and the documentation. It's available to the public. Research it. Work with your tax or legal advisor to make sure that when you make a decision, you make an informed decision. All parties, again, are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment, as well as any type of transaction. So in other words, before you make a move, please consult. We highly recommend to consult with a competent tax or legal advisor to make sure that you are getting the appropriate information to make an informed decision. Now, the agenda for today is briefly, we're going to talk a little bit about the Entrust Group, because we are the one offering this particular webinar. We're going to talk a little bit about what is a self-directed IRA, the benefits of self-direction, and then we're going to dive into the material. We're going to start that off by taking a look at what's the importance of a beneficiary designation form. A beneficiary designation form, I believe, when I do compliance audits for financial institutions in the past, most taxpayers do not pay close attention to the beneficiary designation form. Why is it such an important document? I don't know about you. If I worked hard to accumulate wealth in a retirement plan, I would want to make sure that I specify the appropriate individuals who will get my assets upon my death, whether it be an emergency that all of a sudden somebody passes away, or whether it be your mortality hits, right? So a lot of us are getting older. These bodies that we have right now are deteriorating, so eventually we will face that event called death. Wouldn't you want to have the right appropriate individual get your assets? In other words, do you know the rules that are in place in your retirement plan so that you take control of who gets the assets in your retirement plan? We'll also take a look at the types of beneficiaries. The types of beneficiaries will determine what those beneficiaries' options are in regards to distributing the assets. Now, most of the assets in retirement plans have never been taxed before. And the reason for that is that's why we get the term tax deferred. You're deferring taxation. You're postponing taxation, which is one of the biggest benefits of a retirement plan. Earnings grow tax deferred. It's not going to get taxed until you take it out. But at some point, somebody's going to have to take it out, whether it be you or your beneficiary. The type of beneficiary will determine the options available according to law. We'll learn that today. Next, we'll take a look at the options allowable for the beneficiaries on how they want to deplete the account. Now, we're not talking about what form of distribution, a check, money order, lump sum. That's not what we're going to be talking about. We're going to be talking about what options are available to the beneficiary on how they would like to deplete the account. Do they want to deplete it slowly, meaning less taxation? If you deplete only a portion of whatever is required by law, well, then, of course, majority of the assets will remain tax deferred under the retirement plan. Thus, therefore, maybe even create a stream of payments on behalf of your beneficiaries upon your death. Some people are actually thinking about legacy planning. That's why that's a part of our title. We'll take a look at tax reporting and taxation. Who takes the brunt end of the taxation? And last but not least, how do you get started with opening up an account at the Entrust Group? We don't advocate putting all your assets at the Entrust Group because we want to make sure that you have a diversified portfolio. A diversified portfolio means you have a little bit of your assets in each bucket. So if one goes down, the other one goes up. Or if the other one goes down, the other one goes up. Thus, therefore, maintaining, hopefully, you're leveraging your investments with the ups and downs of different types of the market. Now, some people are in stocks, bonds, mutual funds. Keep a portion of your portfolio there. But there are other alternative investments also that are available to you. Maybe not available to traditional types of institutions like banks, credit unions, or broker-dealers. That's where self-directed provider comes in. We're going to talk about how to get started with the Entrust Group. It's fairly simple. And last but not least, we're going to open up the phone lines for any questions you may have in regards to the materials presented. This is where the education and where the learning comes into play based on your questions. So now let's take a look and talk about a little bit about the Entrust Group. The Entrust Group has been around for approximately 37 years. We've been around for a while, focusing mainly on offering self-directed types of retirement plans. These self-directed retirement plans are retirement plans that, these platform providers like us do not offer any sort of investment. But what we do offer is a platform that allows for you, the investor, to choose whatever types of investments that are allowable under law to be held under your retirement plan. We have over 22,000 accounts with over $3.3 billion in investor assets. And also one of the biggest things that's different about the Entrust Group is that we do have a customer service line who you can speak to. In other words, if you're dealing with retirement plan assets, it's nice to be able to talk to somebody. Our staff is knowledgeable, and most of our staff has what we call a Certified IRA Services Professional designation through the American Banking Association. We also have a school called the IRA Academy that actually not only trains our staff, but also trains the industry staff in regards to getting what we call the Certified IRA Services Professional designation. We have national offices. Some are brick-and-mortar offices. Some we do have representatives within a certain region of the United States, in other words, the East Coast, the West Coast, Midwest, so on and so forth. And last but not least, our education services do qualify for continuing education credits for some of the major designations held by industry professionals, such as the CFP Board for Certified Financial Planners. We are an approved continuing education provider for the IRS, NASB, and other designations as well. Now, what is a self-directed IRA? As mentioned earlier, a self-directed IRA is not any different than any other IRA out there in the industry today. It just so happens that the self-directed IRA offered by a self-directed IRA provider does not basically offer any investment, but instead, it's the IRA holder that chooses to hold whatever investment they would wish to hold under the retirement plan the self-directed IRA provider 98% of the time will be able to hold that particular investment. Why do I say 98% of the time? Because there are what we call prohibited transaction rules that sometimes IRA holders are not aware of. There are only two different types of investments not allowed in the IRA world, in the retirement world. Those are your life insurance contracts and collectibles. There's also another type of entity called an S-Corp that an IRA cannot be a shareholder of. That's why you cannot have that under a retirement plan. But for all intents and purposes, the universe of investments available in the retirement space is vast, such as real estate, precious metals, certain precious metals, notes, private placements. So in other words, if you are looking for a custodian that could hold a particular investments that it's not available under a different type of custodian, like a bank, credit union, insurance company, broker-dealer, so on and so forth, you might want to check a self-directed administrator out. Now, when it starts taking a look at self-direction, what is the benefit of self-direction? Because you take control of your retirement plan assets. You're not limited to whatever investments the investment provider is offering. If you go to a retirement provider, typically they are pitching whatever they sell as an investment to be held under a retirement plan, such as if you're working with a broker-dealer, you're dealing with securities, stocks, bonds, mutual funds. When you're dealing with an insurance company, you're dealing with an IRA annuity. In other words, they're selling an annuity under a retirement plan. A self-directed administrator does not have any investments again. So if you want to hold a piece of real estate under your retirement plan, well, come on over. We can definitely help facilitate that transaction, whereas other institutions that are in the retirement space may not be able to do that. True diversification is also the key in regards to investing. In other words, don't put all your eggs in one basket. Some people say, I have a diversified portfolio, but if you take a look at the portfolio, they may be all in mutual funds. You may be diversified from a securities perspective, but all your assets are still in securities. So it might be good to consider other types of assets that in some cases may be something that you're very familiar with, such as a lot of real estate brokers actually invest their retirement plan assets in real estate. Why is that? Because they understand the industry. They understand that asset class or investing in real estate, that business. That's what I was trying to say, right? So invest in what you understand and what you know. If you can put your arms around a particular investment, such as a business as an example, that can even be a potential investment, of course, avoiding any sort of prohibited transaction or conflict of interest, those can be held under an IRA with a self-directed administrator. Of course, you will still receive the same benefits as contributions may be tax deductible depending upon the type of retirement plan you choose. And last but not least, the earnings on retirement plans are tax deferred. In other words, you postpone taxation while it's under the umbrella of the retirement plan. And in some cases, depending upon the type of retirement plan you have, the distributions may also even be tax-free. In other words, if depending upon the type of retirement plan you choose, you may not have to pay any taxes in the future for any growth under that retirement plan. Now let's dive into the material. Enough of us and enough of what we do. All right. The focus again of this particular course is to talk about what happens to your retirement plan assets upon your death. I mentioned earlier already, a lot of people are getting older every year. As a matter of fact, all of us are. And eventually we may face this particular event in life called death. Mortality will kick in. I don't know if you know this, but there's around 78 million people born between 1946 and 64. And around 10,000 of them are turning 60 every day. Those are what we call the baby boomers, 78 million of them. The next generation, my generation, Generation X, has around 68 million people within that category, and there's also other generations within that number. So you're looking at around approximately 140 million people that are reaching that magical age called retirement. But to prepare accordingly to make sure that your rightful heirs get your assets upon your death, it is important to understand and pay close attention to updating forms such as your beneficiary designation form. Some individuals may not even remember who they named as a beneficiary, which could be problematic. Why is that? Once you die, who is the custodian going to call if there's not enough information on the beneficiary designation form? In some cases, the assets may even have to be turned over to the state as what we call unclaimed properties. So it's good to, every 3 years, 2 years, depending upon how complicated your life is or how simple your life is, to make sure that the rightful heirs are named under what we call a form called a beneficiary designation form. The percentages, if you have multiple beneficiaries, on what each individual is supposed to receive is also very, very important. Make sure that you appropriate the right percentages to each one of the beneficiaries. Make sure that the right percentages are also stated on the document to make sure that there's no ambiguity or confusion upon your death on how much each individual receives. Some individuals may even pinpoint a specific investment to be left for specific people, such as if you have 10 children, if you have 10 pieces of real estate, one piece of real estate may be appointed to each child, so on and so forth, to preserve whatever each individual is entitled to. Now, keep in mind, IRAs are valid trusts under state law. In other words, it is actually a trust document. When Congress created Section 408 of the Internal Revenue Code, one of the provisions states that an IRA must be a valid trust under state law. Trust documents or trust instruments allow for the grantor, the IRA holder, to name individuals under that document on who's going to receive the assets upon their death. Now, some people may say, well, what happens to my will? How does that come into play with an IRA document? Well, as long as there's somebody named in the IRA document, wills do not supersede the IRA trust document. So therefore, you could have different beneficiaries for your will for other assets, and you may also name different beneficiaries in your IRA. Now, it is good to know that even though you don't name beneficiaries in your IRA, most documents, properly drafted documents out there, will have a default beneficiary. And most IRA documents in the United States default their beneficiary to the individual's estate. Estates of an individual become public record. So therefore, you might want to talk to a competent tax advisor if you need some help in regards to who to name as a beneficiary. Help them walk you through that. Because if you don't name a beneficiary, the IRA document most of the time will write one for you. Now, there are some financial institutions out there that have a different default beneficiary. They may say that if you are married and you don't name a beneficiary, that your spouse may automatically be the beneficiary. Or in some cases, if you don't have a spouse, your children become the beneficiary. And then if there are no family members, then the estate becomes named as the beneficiary. Again, all estates become public record. Now, how do you want to avoid that? Name somebody. In the entrust document, I'm going to use ours as an example. The default on our document is the person's estate. So if you have an IRA document or an IRA at the entrust group, the default beneficiary of the IRA is always the estate if the IRA holder does not name somebody, right? Again, the last will and testament does not override the IRA trust beneficiary designation form. So in some cases, some people might say, well, no, I don't need to name a beneficiary. I have my will. You might want to take a look at that document again to ensure that the proper people will get your assets upon your death. Again, last but not least, state trust law governs IRA beneficiary designation forms. So depending upon where your IRA is located, and what I mean by that is some of the people attending this course may not have an IRA at the entrust group. You're just using us for educational purposes. The state trust law that the IRA document specifies is the state trust law that will govern that IRA document. So in some cases, you may live in a community property state where you have an IRA established, and let's say that state law governs that IRA. Well, if it's a community property state or a marital property state, in some cases, your beneficiary may automatically be the spouse. So therefore, if you want to name somebody else besides your spouse as a beneficiary, the spouse may have to sign off on that. Again, if you want somebody to walk you through that, seek out a competent legal or tax advisor or even an estate planner to make sure that your paperwork is in order so that in the event that death does come into play, that the rightful heirs receive the assets that you've worked so hard for. Now, who can you designate as a beneficiary? The IRS breaks it down into two types of individuals. One is an actual person or persons, And last but not least, a non-individual. The individual could be your spouse. In some cases, some people don't name their spouse as a beneficiary because for estate tax purposes, which is another course if you folks are interested in that, your spouse may not be a good beneficiary to name based on your situation. In some cases, the spouse may be a good beneficiary to name. But again, that's where your legal, tax, or estate planner will come into play on really working through who is best to name in your IRA. It may be different from IRA holder to IRA holder. Spouse, children, grandchildren, those are types of what we call individual beneficiaries. Why is that important to delineate or give a distinction? Because people have life expectancies. Life expectancy is used to determine how slowly distributions come out of an individual's account upon their death payable to the beneficiary. If there is no life expectancy because the individual that was named was a non-individual, such as a charity, such as a trust document, what we call a non-qualified trust, and last but not least, an estate, those are just examples. Well, if there's no life expectancy, you might have basically eliminated some of the options by virtue of who you named as a beneficiary. Now, you may be asking, who should I name then? Well, that's where, again, a competent legal or tax advisor would be helpful in regards to walking you through who is best to name in your IRA. Now, what types of information is important in that beneficiary designation form? Make sure that there's the name is number one, important. Number two, an address or a social security number, because eventually, once you pass away, distributions out of your retirement plan will be made payable to the beneficiary using the beneficiary's social security number. If the custodian does not have that social security number, it could be problematic in regards to that beneficiary getting the assets that they've inherited. The date of birth is also very important because in determining life expectancy, the date of birth or the age of the individual will determine whether or not the beneficiary will have a long period of time to deplete the account or a shorter period of time to deplete the account. Relationship to the IRA holder is also very important, especially if you name your spouse as a beneficiary. Why is that? Because spouse has additional options in comparison to other individuals called non-spouses. And last but not least, again, the share percentage that you're allotting to each beneficiary if you name multiple beneficiaries. Use the beneficiary designation form of the custodian that you have and also understand how that beneficiary designation form has been constructed. In our beneficiary designation form at the Entrust Group, as an example I mentioned to you already, the default beneficiary in our document is the estate. If you don't use the Entrust Group's IRA document, check that financial institution's IRA document on who their default beneficiary is so you're aware of it. Let your beneficiaries know where all important documents are located. What happens most of the time is that when we have an IRA holder who passes away, has not notified the beneficiaries of their assets, beneficiaries are coming to us maybe 3 years down the line or 4 years down the line because they weren't aware that an IRA was even in existence for an individual IRA holder. And secondly, they weren't aware that they were named as a beneficiary. Beneficiary distributions or small amounts or maybe even a large amount that's required to be distributed by a beneficiary, if not distributed timely, has a penalty. Ready? There's a 50% penalty on any amounts that are required to be distributed but are failed to be distributed. That's under Section 4974 of the Internal Revenue Code. Because distributions to beneficiaries are considered required minimum distributions. Give your beneficiaries a fair shot. If you are naming somebody, just let them know that there is an IRA at a particular location, or maybe even an inventory of all your retirement plan assets, where their locations are, who maybe their contact is, so that in the event of death, your beneficiaries would know what steps to take to get those assets that they've just inherited. And lastly, you work so hard for to make sure that they get it. Find, again, a licensed advisor or estate planner in your state Why in your state? Because they need to be aware of state law as well. Just because you may have a competent legal counsel, they might not be aware of the state law dealing with your account at a particular financial institution, maybe in the same state or another state. Make sure, again, that you have a competent advisor, legal advisor, or estate planner. All right? Enough said. Get as much information as you can to the custodian when you fill out the beneficiary designation form. A couple of things that are missing in here that I would like to add. Maybe provide the email address if you don't have the Social Security number or other types of information from the beneficiary. Email address, a telephone number would also be helpful so that the custodian would know who to call once they do receive a death certificate upon your death. All right? Enough said. The different types of beneficiaries typically found on the beneficiary designation form is what we call a primary and contingent beneficiary. Now, are we limited to primary and contingent? No. There's tertiary beneficiaries, 4th, 5th, and 6th. It's not necessary. It's not necessarily limited to just the two that I'm talking about. But in an 8.5 by 11 sheet of paper, typically a financial institution is limited to, number one, who would you want to name first as your beneficiaries? In other words, do you want to name your spouse? Or if you don't have a spouse, you want to name your children. If you want to name your children, are there multiple beneficiaries? Those are what we call the first line of people who will receive your assets. Now, why would you want to have a backup plan or a contingent plan? The reason for that is what if something happens to all your primary beneficiaries and they're all gone? Wouldn't you want to have a contingent plan to make sure that the contingent plan only kicks in upon the death of all primary beneficiaries, as an example? Well, you might want to plan for that, because if you don't name a beneficiary again, the document will name a beneficiary on your behalf. I don't know about you, but I'd rather name my own beneficiary than the document defaulting a beneficiary which I did not intend to name in the first place. The primary beneficiary, again, is a person or persons that are named to receive the assets upon my death. Now, one of the biggest design features of that particular document is that you might want to know about, or you might want to ask about, is how is that document written? Most documents in the United States are written on what we call a per capita basis. Now, I'm going to get a little technical on you a little. Per capita is a legal term for of the head. What does that mean? If any primary beneficiary dies before you do, in other words, you're still alive and a primary beneficiary, as an example, dies, well, their proportionate share is gone. What happens to their proportionate share, you might ask? Well, their proportionate share gets divvied up to the remaining primary beneficiaries. Let's say you have 3 children, Joe, Jim, and Sarah, and you name them equally across the board, 33.333%, which I don't recommend, by the way. Name somebody at 34, your favorite, right? Then we have equal numbers. Joe, Jim, and Sarah. If you name the 3, and let's say something happens to Joe, well, in the per capita method or a per capita design of a beneficiary designation form, Joe will lose his proportionate share. Joe's proportionate share will be divvied up to Jim and Sarah. Now, you might be asking, well, Joe has a family. I want Joe's family to receive that. Well, if the beneficiary designation form is written on a per capita basis, Joe's proportionate share is gone. Joe's share will no longer be received by his family. It will go to Jim and Sarah. Now, you may be asking, well, can Jim and Sarah give it to Joe's family members? Well, they could, but the taxation will be under Jim and Sarah. So most of the time when we get calls, some people will say, well, you know, our oldest brother passed away, but we want his family to receive that. Well, unfortunately, the way the document is written may prohibit that from happening. Per capita, again, is a Latin term of the head. If any primary beneficiary, or beneficiary for the matter, predeceases the account holder, they're out of the picture. When do contingent beneficiary come into play? It's only when all primary beneficiaries are gone. That's one of the reasons why we're doing this particular seminar is, have you taken a look at your beneficiary designation form lately? And number one, do you remember who you named? Is there enough information in there? And number two, has any life event changed since you named your beneficiaries? Have you gotten remarried? Do you have a new child? Or did you adopt a child? Or are one of your children or one of your beneficiaries, have they passed away? Those are significant life events that could affect who's going to receive your assets upon your death. Again, a competent tax or legal advisor will be more than happy to walk you through that process. Again, if you have any questions, please jot any questions down you may have in regards to the material presented so we can answer those when we open up the phone lines for question and answer. Here's an example of a per capita. IRA holder names two beneficiaries 50-50. One of the primary beneficiaries predeceases the IRA holder. That primary beneficiary's assets will now be moved to the remaining primary beneficiary, and the descendants of that primary beneficiary will not receive anything. All the assets will go to the remaining primary beneficiary. Now, let's take a look at what are the options of beneficiaries upon the death of the IRA holder. Now, we're going to take a look at the traditional IRA first, and then we'll talk about the Roth IRA. Some of you may have a traditional, some of you may have Roth, some of you may have both, all right? So first, let's take a look at a traditional IRA. Now, characteristics of a traditional IRA. Traditional IRAs have typically never been taxed before. When I say typically, it's kind of a weasel legal answer that it might not be all the time, because some people may have made what we call non-deductible contributions to a traditional. Those assets have already been taxed. But generally, interest in an IRA has never been taxed before. Contributions have not been taxed because individuals use it as a tax deduction. Now, people have accumulated most of the assets, most of the $8 trillion assets in IRAs currently. There's $26 trillion in retirement plans, and most of the assets in retirement plans are actually in traditional IRAs and Roth IRAs, surpassing your 401k plans, 403bs, and governmental 457b plans. Why is that? Because people are getting older, they're retiring, they're moving assets to IRAs. That's why we're starting to do seminars like this to make sure that you know how to handle your IRA documents, or at least give you enough information to ask the right questions on what happens to my account when I die. In a traditional IRA, depending upon how old you are when you die, right, will determine the options made available to a beneficiary. The significant date is April 1st of the year following your 70.5 year. Why is that? Some of you may already be aware of this, but some of you may not. That when an individual turns 70.5, and if you have a traditional IRA, you are required to start taking a minimum distribution out of your IRA. Why is that? Uncle Sam is saying, I've allowed for you to postpone taxation on those assets. When you reach 70.5, age 70.5, it's my turn. You're going to have to start depleting that account. The depletion of the account will be determined based out of your life expectancy associated in a table called a Uniform Lifetime Table. Now, this is not an R&D class, but this does apply to beneficiaries as well. If you die, if you turn 70.5, you're going to have to start taking a minimum amount. And if you don't take that minimum amount out timely, there's a 50% penalty on that minimum amount. So if you have a $5,000 required minimum distribution, well, you will owe the IRS $2,500. Now, keep in mind, when you distribute that, you will be subject to tax. No penalty because you're past 59.5. You'll be subject to tax, federal, state. Some people, kind of take a look at the numbers and go, do I want to distribute this and get taxed on it, or do I just want to pay the penalty? But nonetheless, if you have a required minimum distribution, you have to take it out, or else you get a penalty. So it's either you take it out or pay the penalty. Now, why am I explaining that? Because if a person dies before age 70.5, to be specific, April 1st of the year following the age of 70.5, well, there's nothing required. If there's nothing required, that tells us that the options made available to beneficiaries are slightly different to beneficiaries of individuals who have already started taking required minimum distributions. Now, how do we delineate the two events? We're going to first take a look at individuals who passes away before April 1st of the year following the 70.5 year. You might be asking why April 1st, because for the first year, once an individual turns 70 and a half, they can postpone their typical deadline of December 31st to April 1st of the following year. In other words, instead of taking one for each year, if they postpone their first year's required minimum distribution, they have two that year. But that is the ultimate drop-dead date that an individual must satisfy their first year's RMD. It's April 1st of the year following the 70 and a half year. But if somebody dies before that date, in other words, they die and they're 70 and a half, but they die on March 31st at 11:59 in the evening, they still died before their what we call required beginning date. If an individual dies before the required beginning date, the beneficiary has two options on how to deplete the account that they've inherited. In other words, the options, again, do not pertain to the form of distribution, check, wire. That's not what we're talking about. We're talking about how do you want to deplete that account that you just inherited from this individual, in this case, who died before they started taking required minimum distributions. The first one is what we call the 5-year rule option. The 5-year rule option means the beneficiary does not have to do anything until the year that contains the 5th anniversary of the account holder's death. In other words, if a person died in 2019, well, the first anniversary is 2020, 2021 is the second year, 2022 is the third year, 2024 is the fourth year, 2025 is the fifth year. In that fifth year, the individual, the beneficiary who inherits that account, if they choose the 5-year rule option, must deplete everything in that account by December 31st of that year. Or else, they will get a 50% penalty on the amount that's not distributed. Now, keep in mind again, the 5-year rule means that everything has to be distributed. Let's take a look at an example. What if there was $500,000 in there? You know what the penalty is of $500,000? That's 50% of that. That's a big chunk of change. Now, does this raise awareness to, you might want to let your beneficiaries know what the options are so at least they know how to react in the event of death. Okay, now the other option made available to the beneficiary is what we call the single life expectancy payments. Single life expectancy payments is a Spanish term of using the life expectancy of your beneficiary to determine the small amount of distribution that's required every year. Now, the younger the person is, the larger their life expectancy. The older the person is, the shorter their life expectancy. What do we do with that life expectancy? We take the prior year end balance for the year's RMD, and you divide that by that life expectancy. So in other words, if somebody has, let's say, $200,000 in their IRA, they pass away before they started taking required minimum distributions, the beneficiary has the option to deplete that account using their own single life expectancy. For example, the life expectancy of a 30-year-old, let's say, is 51. You know what that means? They have 51 years to deplete that account. They are allowed to continue to keep that balance in that account, IRA, under the umbrella of the IRA, called an inherited IRA account, and allow for that investment to continue to grow tax-deferred, and they will only be required to distribute that small amount. Another way to look at that is that you can create a stream of payments for that beneficiary for their lifetime based on the amount that you left to them in your retirement plan. Imagine if you had an apartment complex under a retirement plan and you're getting rental checks. Those rental checks, assuming it's enough to satisfy the required minimum distribution, could be distributed for the life of your beneficiary upon your death. Well, enough said. That's very powerful right there, because some of us are not saving up assets in a retirement plan just for ourselves, but we're saving it for a legacy. In other words, you're saving it for somebody else. Now, that's the option first if a person passes away before the required beginning date. In other words, before they start taking required minimum distributions. Now, if a person dies after they've started taking required minimum distributions, what are the options of a beneficiary? Well, they no longer have the option to prolong the distributions for 5 years. Why is that? Because distributions have already started. Those required minimum distributions are required, so it cannot stop. So therefore, the only option that beneficiary has is the life expectancy option. They must start taking life expectancy distributions along with the required minimum distributions for the IRA holder in the year of death. Moving forward, they have to start taking those small incremental distributions based on their own single life expectancy yearly. Now, you're probably saying, this is so complicated. Well, that's where your custodian comes into play. The custodian can actually assist in figuring out what that minimum amount is so that the beneficiary does not get that 50% penalty, and as long as the beneficiary knows that there is an IRA that was actually left to them and that they have inherited. So again, there's two options if a person dies before taking the required minimum distributions, and there's only one option for the beneficiary if the person died after they've started taking required minimum distributions. And if they fail to take out that amount, there's a 50% penalty on what's required. All right. Here's another slide again. The 5-year-old option applies when the IRA holder hasn't started taking RMDs. On the 5th anniversary, everything must be distributed. Now, number 2, life expectancy payments. Life expectancy payments must begin by December 31st of the year following the year of death. The amount is based out of the single life expectancy of the beneficiary. Failure to distribute the amount will basically incur a 50% penalty on the amount that should have been distributed. Here's another example of the 5-year-old illustration. Person died at age 61. In other words, they're not 70 and a half. Then the 5th year, everything must be distributed to that beneficiary, or else whatever's left in that inherited account will incur a 50% penalty. Now, does that amount still need to be distributed? Yes, of course. Once that amount is distributed, it will also incur taxation. So in other words, that's one way for the Congress to deplete that account is to tax it heavily, 50% plus an additional tax. So it's good for the beneficiaries to know that they have been named as a beneficiary, as well as they might want to understand what their options are from there. All right? Now, here's an example of the single life expectancy table. If you want to see an example of it, you can actually go to Google IRS publication 590. And on the back of that publication, you will see this table called the single life expectancy table. Right? Life expectancy illustration, beneficiary age 60, the year after death. The life expectancy of a 60-year-old is 25.2. Annual distributions will be based out of the single life expectancy of the beneficiary. They will have 25.2 years to deplete that account. If the balance is $200,000, assuming that there is no interest being earned, of course there's interest, right? I'm just using this so that it's, we can illustrate it easier. 200,000 divided by 25.2, 7,900 is what they will have to distribute that first year, and then the calculation will have to happen again the following year. So at least you will know that the 200,000 will be prolonged for 25 years on behalf of your beneficiary, which means it could create a stream of income on their behalf if they just elect the life expectancy option. Now, another question that I get a lot is, can they take more than that? Sure. Not advisable, because if you want this thing to last longer, but at least you know what the minimum is. But you can absolutely take an amount larger than what the required minimum distribution is. The required minimum distribution only tells the individual that they're not going to be subject to a 50% penalty, but they always have access to more than the required minimum distribution. Now, special distribution rules for spouses. If the spouse is left as the beneficiary, the spouse can take it out of the umbrella of the deceased individual and move it to their own. Why would they want to do that? Now, because, let's say you are, required to take required minimum distributions out of the deceased individual, but you yourself is not 70 and a half. Well, you might want to take it out of the deceased individual's IRA and move it to your own. That is available at any time. Now, there are some cases a portion of the assets might not want to be treated as your own. Why is that? Let's say the IRA holder died at 55. The spouse is 45 years old, and that spouse may need some of that money to distribute those assets for living expenses. Distributions out of a dead individual's IRA is exempt from the 10% penalty. In other words, it's a death exemption to the 10% penalty. If that spouse treats that IRA as their own, in other words, move the assets to their own IRA, a 45-year-old who's alive, because assets were moved, right? A 45-year-old who's alive, if they want to take a distribution, will not only be subject to tax, they'll all be subject to a penalty. The reason why it's good to know what these rules are is to avoid getting, unintended consequences that could happen by by treating the assets as their own, they may have lost out on that opportunity to take penalty-free distributions, as an example. But one of the options, the only one that has this option is the spouse. The spouse can always treat those assets that they've inherited from a deceased spouse as their own. But the timing will depend upon each individual situation. Now, we talked about traditional IRAs and spent about half of our lives talking about that. Now let's take a look at a Roth. In a Roth IRA, there's no such thing as a required minimum distribution. So therefore, we never have that age 70 and a half to reckon with. So what options are available to a beneficiary of a Roth IRA? There are two options. It's the 5-year-old option or the life expectancy payments. And last but not least, if the beneficiary of the IRA holder is a spouse, they can always treat it as their own. So in other words, the same options are maintained by a Roth beneficiary. It just so happens that there's no required minimum distribution in a Roth. Therefore, the two options are retained by that beneficiary as options on how to deplete the asset upon the death of the IRA holder. Right. All right, moving right along. Common mistakes. Distributions from inherited accounts of non-spouse beneficiaries or non-individuals cannot be rolled over. What does that mean? Some beneficiaries sometimes take a distribution out of the inherited account thinking that they could move it to another inherited account. Once you distribute the assets, you basically used up that option, and that cannot go back into another tax-deferred account. The only one that can do that is a spouse, because the spouse is the only one that can actually treat those assets as their own. Common mistake 2. The assets in an inherited account can only be transferred to the beneficiary's own IRA when the beneficiary is a spouse. Some inherited account holders think that they can actually just move that to their own IRA, and the answer is, if you're a non-spouse, you cannot do that. Only the spouse beneficiary can do that. Another common mistake is spouse beneficiaries who choose to treat inherited IRA assets as their own cannot move those assets back into an inherited account. A spouse beneficiary might say, I inherited my husband's IRA, I'd like to move that to my own. Now, later on, they find out that distributions out of their own IRA is subject to a 10% penalty because they're under the age of 59 and a half, and they would like to move that back into an inherited account. You can't do that by law. That's not allowed. So make sure that before you do any action, check with the tax or legal advisor, or check with your custodian, like the interest group. Beneficiaries are often unaware that they have been named as a beneficiary in someone's account. Common mistakes, again, the IRA holder has not talked to their beneficiaries and has not notified them that there is an IRA that they have been named as a beneficiary. Therefore, they're not aware that they had actions, they had steps to take upon the death of the IRA holder. Last but not least, required minimum distributions must still be distributed even in the year in which the original account holder died. If an IRA holder died and they're 70 and a half, there's required minimum distributions. If the IRA holder had not satisfied the required minimum distribution prior to dying, somebody has to satisfy that required minimum distribution on behalf of the deceased. And guess who that is? It's the beneficiary. So it's really good to make sure that the beneficiaries know that there are assets that they are inheriting so that they can actually take the necessary steps to avoid not only not having distributed the amount, but also the penalties associated for failing to distribute those amounts. I hope this seminar opens up questions for all of you, because it's good to be prepared for that event. Here are some tips to ensure your retirement savings go to the right heirs. Complete the beneficiary designation form with all necessary information per IRA that you hold. And make sure that however you fill that out is reviewed on an occasion-by-occasion basis. Some people feel it's necessary to do it yearly. Knock yourself out. Some people feel it's 3 years is enough. Some people feel you only have to review it when there's a life change. It's up to you. But make sure that you create ample steps to make sure that the appropriate beneficiaries are named in those beneficiary designation forms, and make sure that there's enough information so that the custodian can actually contact the beneficiaries upon your death. Make sure up-to-date beneficiary designation form on a regular basis. Keep copies of these forms. It is okay to keep a copy of who you named as a beneficiary in a particular IRA, keep it somewhere so that when you die, the beneficiaries would actually know who was named. Why is that? Just to make sure that there is record of it. Communicate to family members or heirs where you keep these documents so they can find them. Have meetings, or even have, let's say, your legal counsel, if you have one involved, make sure that the heirs are notified accordingly on where the assets are so that they are aware if there's any assets that have been left to them. Anyway, enough said. The beneficiary distribution reporting and taxation is taken on, the taxation of the distributions will be taken on by the beneficiary. As a matter of fact, page 8, which is a cutout on this particular presentation, of the 1099-R instructions by the Internal Revenue Service, that if you make a distribution to a beneficiary, trust, or estate, prepare the 1099-R using the name and tax identification number of the beneficiary, trust, or estate, not those of the decedent. Now, if there's not enough information in the beneficiary designation form, and you pass away, and your beneficiaries are now wanting to take distributions, if there's not enough information on that form, there may be a delay in distributing those assets to those beneficiaries. That's why it's good to make sure that there's enough information for the custodian to be able to facilitate the process of transferring those assets into an inherited account and of course, instruct your beneficiaries, if they know that there is an IRA that they've been named as a beneficiary, on what their options are. So it may come as a shock to some people that assets in an IRA that have never been taxed before are going to get taxed upon distribution. And that will be another hit that they would have to take. It's either that or a 50% penalty, right? So again, that's one of the biggest benefits of accounts that are tax-free, like Roth accounts, because the distribution will be tax-free if certain criteria is satisfied. But for the most part, the person that's receiving those assets will receive a 1099-R. And depending upon the type of IRA that they've inherited, will determine whether or not there's taxation, right? How to get started with the Entrust Group if you want to open up a self-directed account? Well, you can open an account with the Entrust Group through our site. We do have a portal that actually can walk somebody through opening up an account with us. Opening up an account means that you just have an IRA, the shell, the trust. You have to fund it with something, either be contributions, or you can move assets from other retirement plans, such as you can do a direct rollover from your 401k plan, or transfer assets from other IRAs of the same type, traditional to traditional, from another financial institution like a broker-dealer or a mutual fund company. From there, once your account is funded, then you can choose whatever assets you choose to. Unfortunately, Entrust cannot help you in that because, again, we don't offer any investments. You can invest in a broad array of investments because you're the one that takes control of what you want to put under your retirement plan. Again, it's a 3-step process. Open up an Entrust IRA, whether it be traditional Roth. If you have a business, you can open up an employer-sponsored plan like a SEP or a Simple. Fund your account from other assets from other retirement plans or make a contribution. And last but not least, instruct us on what asset you want to purchase. Simple as that. Our website is www.theentrustgroup.com. www.theentrustgroup.com. Okay, I've probably exhausted your ears in regards to all my talking. Now I'm going to open up I'm going to read some of the questions that have been presented, and we'll try to answer them. Okay. I have a question here. How do non-liquid assets get distributed to beneficiaries? Well, if it's an illiquid asset, they could distribute the asset in kind if they wanted to. Of course, it does require a little bit of valuation on that particular asset. So if the asset has a valuation, like, for example, a piece of precious metal or something like that, then the current fair market value at the time of the distribution will be the taxable distribution of that illiquid asset. Or, if you don't want to sell the asset, as an example. If it's an illiquid asset, a certain percentage will be distributed in the form of whatever paper that asset is, and whatever the fair market value at that time is will be the amount reported on that 1099-R. If it's illiquid, it just means that you can't sell it, but it still has a value. If there is no value presented to the custodian, we will report the last value. Then it's up to whoever receives it to duke it out with the IRS at that point to actually get an appropriate value. That's why it's important for IRA holders to have a chat with their beneficiaries, because it's not up to the custodian to come up with that value. Article 5 of the trust document says that the grantor of the trust or the IRA is responsible to provide to the custodian the appropriate, valid and accurate paperwork to make sure that the custodian is able to satisfy the reporting requirements for that IRA. All right. I hope that answers your question. How do RMD rules for Roth IRAs post-death? Of course, there's no RMDs in Roth, but the RMD rules do kick in for the beneficiaries. Again, as mentioned in that slide, once a person passes away in the year of death, there's nothing required. But in the year after death, however, the beneficiary has two options that they can choose from. It is an irrevocable decision. In other words, if they choose the 5-year rule option, they don't have to do anything for 5 years, but on the 5th year, everything has to be distributed. If they choose the life expectancy option, well, then they can deplete that account incrementally using their single life expectancy. In other words, taking the balance in the Roth IRA divided by their single life expectancy, and that amount will have to be distributed for that year. It will not be required to distribute the full amount, but the small amount will be distributed based on that calculation. So I hope that answers your question. Again, it's a 5-year rule option or life expectancy payment. That would be for the post-Roth, post-death Roth distributions for beneficiaries. All right. Another place to look for this information is IRS Publication 590B. And look for required minimum distributions and beneficiary options. Everything that we're talking about will be there in greater detail. Here's another question. Can IRA or Roth can be transferred to a beneficiary while alive? The answer is no. Article 2, in other words, if somebody says, I'd like to take my assets and just transfer it to a beneficiary, you can't do that. Article 2 of traditional IRAs and Roth IRAs state that IRAs are non-forfeitable. The only time you can forfeit an asset in an IRA is upon death or divorce. The one we're talking about is death. So you have to die in order for your beneficiaries to get your assets. Okay. How does it work when you own real estate in your self-directed IRA? Does the beneficiary have to sell the real estate in the account when you die? The answer is you can keep the piece of real estate as long as the minimum distribution is being satisfied, and hopefully there's cash. Let's say the real estate earns rental income, and let's say the rental income is enough to satisfy the required minimum distribution. Well, then the piece of real estate does not have to be sold. It just would have to be re-recorded to the name and to the name of that beneficiary upon the death of the IRA holder. It'll be actually recorded as an inherited account. There's a revenue procedure. I'm going to go technical on you. There's a revenue procedure 89-52, that says if it's an asset owned by an IRA, you keep the dead person's name in there, and then you name the beneficiary, and then that distribution will be reported under the name and social security number of that beneficiary. So here's a naming convention example in that revenue procedure. John Doe deceased for benefit of Jane Doe. Let's say Tarzan deceased for benefit of Jane Zan. Then at least Jane Zan's name and social security number will show up on the 1099-R, and if there's cash, then the piece of real estate does not have to be distributed or sold. But if there's no cash and they want to distribute, well, distributing pieces of real estate incrementally gets to be, it can be done, but it's expensive. Why is that? Because you have to re-record every portion of that piece on a yearly basis. It's better when you have cash. So if there's rental income, yeah, use those first. And then if it's enough to satisfy the RMD, distribute that rental income. Or if it's not, well, then distribute as much cash as you can. Another option is to go ahead and pay the 50% penalty on whatever remaining amount was not distributed. It keeps the piece of real estate intact. Yeah. So there are options to a beneficiary when they inherit, let's say, a piece of real estate. I hope that answers your question, or at least gives you an idea what the options are for beneficiaries upon inheriting a piece of real estate. So to answer your question, does the piece of real estate have to be sold? It doesn't always have to be sold. Take a look at what your options are first. Is there cash? If there's enough cash, not an issue. If there's not enough cash, distribute the cash, pay the 50% penalty. On a last resort basis, sell a piece of real estate so that, or the beneficiary sells a piece of real estate so at least they can satisfy the required minimum distributions, so on and so forth, right? Another question, if real estate is in the IRA along with rent, what happens to the real estate in the IRA? Can it remain in the IRA while the rent is distributed? Yes, absolutely. You can have a rental property in an IRA that could create a stream of income for that beneficiary for their lifetime if they wanted to. Because keep in mind, single life expectancy of the beneficiary is what determines what's required to be distributed. And as long as there's enough cash to distribute, well, then the RMD could be satisfied that way. Or if there's not enough cash, tell the beneficiary to pay the 50% penalty. Keeps the piece of real estate intact. So again, similar to the previous question, you don't have to sell the piece of real estate. There are options. All right, here's another question. If you buy a rental home in your regular 401k, how do you take RMD if rent income does not meet the RMD requirements? Well, if you have rental property in a 401k plan, first, are there any other assets to satisfy the required minimum distribution? Well, if there's not, well, then might have to sell a piece of property. This is not an IRA. The question is no longer an IRA. This is a 401k plan. In a 401k plan, 401k plans are treated differently than IRAs. Failure to take a required minimum distribution could be a plan disqualification issue. IRAs do not get disqualified by not distributing an RMD. In a 401k plan, it could be a plan disqualification issue because 401A9 of the code, 401A is the code deals with qualified retirement plans, and the 9th provision, 401A9, says that an RMD must be satisfied on a yearly basis. So if you have a 401k plan, you don't satisfy the RMD, big repercussions. So if you have rental home in your 401k, you don't have any cash, here are your options. You might want to consider taking a distribution in kind of that piece of property. Again, it's going to cost you because you're going to have to get an appraisal for that piece of property. You're going to have to be the portion of that property is going to have to be re-recorded to actually show physically that amount was distributed from the 401k plan, or just sell the rental property, and then that will generate cash to allow for that distribution to take place. Again, we're not the ones that made these rules, but those are the options. Right? I hope that answers your question. Roxanne Moss, in the process of creating trusts with my estate planning attorney, will I be able to place a Roth IRA and precious metal account into each trust? And is it a revocable or irrevocable event? Okay. When you have an IRA, you cannot name assets under an IRA under a trust. Why is that? Because an IRA is already a trust. So if an IRA is already a trust, you can name beneficiaries underneath that IRA on who's going to receive those assets upon your death. So really, when you're having that conversation with your legal counsel, you might want to say, who should I name as a beneficiary under this IRA, right? Because IRA assets, again, if it moves under the name of a separate entity, is considered a distribution. There is actually a private letter ruling that by renaming the IRA underneath the name of a trust, well, it created undue consequences. The IRS says by renaming the IRA in the name of the trust, everything was distributed at that point. So I wouldn't take any action until such time you check with your tax or legal counsel. All right? Again, I hope that makes sense. You really don't put the assets underneath the name of the trust if it's an IRA because it's already a trust. You can name a trust as beneficiary, or if you want those assets in your IRA to go to somebody, an IRA is a trust already, name beneficiaries. Sandra, if you have a rental property, can you change the title to make it owned by the IRA? No, you cannot. You can purchase real estate using retirement plan assets that have been contributed already, but you cannot contribute real property into an IRA. there are rules in regards to what can be contributed to an IRA. I've been asked this question before. I have a piece of rental property that's worth $250,000. Can I just retitle that under the IRA? You cannot, because contributions have limitations, such as the annual contribution is only $6,000 for 2019 for someone under age 50, $7,000 for someone who's age 50 and over. All right. If it's a SEP contribution, it's the lesser of 25% of income or $56,000. Now, where do most assets in an IRA come from that actually allows for them to buy real estate? They're called direct rollovers from 401k plans. Let's say you have a retirement plan from a previous employer. That amount can come into the IRA, and then the IRA can purchase a particular investment. If you already own the property, you cannot buy it from yourself. It's called a prohibited transaction. But you can buy a piece of property using those assets that have been contributed already within the contribution limits to purchase pieces of real estate. So in other words, if you work for an employer, you have $300,000 in a 401k plan, and you, let's say, have quit, retired, or, whether it be quit voluntary or involuntary, means you have a distributable event, you can directly roll over those assets from that 401k plan into an IRA and then instruct your custodian to buy a piece of real estate. But you cannot just put any piece of real estate and retitle that under your plan, because there are contribution rules. I hope that makes sense, and I hope that answers your question. Here's another question. Can you sell the asset to yourself? Who determines the value? You cannot sell the asset to yourself. If you have an IRA and you have assets in an IRA, you cannot interact with yourself. It's called a prohibited transaction. There's a good section of the IRS website devoted to prohibited transactions and retirement plans. Now, how do you get that piece of property out of the IRA? You can distribute that property in kind. And how is the value determined? Well, an appraisal would have to be availed of, and there's a cost to that. So the individual IRA holder would have to get an appraiser for that property provided to the custodian to be reported on a 1099-R to the IRS, and that, of course, that amount will either be taxable if it's traditional, and if it's a Roth IRA and you've satisfied the criteria, it could be non-taxable. So the taxation will be dependent upon the type of IRA, but you cannot sell it to yourself. It's, again, called a prohibited transaction, because what you're doing is exchanging the cash, right, with an asset in a retirement plan. You're putting the cash into the retirement plan. You're taking out the asset. You can't do an exchange. It can be distributed, but it cannot be exchanged. I hope that answers your question. All right. Rephrase. If you have an apartment building owned by the IRA, how often do you need an appraisal to determine the RMD? If there is a non-cash asset in a retirement plan and you want to get the true fair market value of that IRA, the appraisal may be required on a yearly basis. Why is that? Because the appraisal determines a prudent calculation of the value of that piece of real estate to calculate a taxable event, which is accountable to the Internal Revenue Service. So custodians will always require the most prudent form of valuing a piece of real estate, which is an appraisal, which therefore it will be required on a yearly basis. Now, do you need to get an appraisal just to distribute assets in a retirement plan? Well, they could require that. If you don't get an appraisal, can you just or not even take a distribution, or just take a distribution and hope that it's enough for your RMD? You can always do that too, but there's no guarantee that you're going to be distributing the right amount. So to answer your question, typically, if you have an RMD, how often do you have to get an appraisal? For every distribution, you have to get an appraisal. I hope that answers your question. What are implications, repercussions of a 401k plan being disqualified? Okay, what happens when a 401k plan becomes disqualified is the tax court. The court case that we look at and determines what happens when a plan gets disqualified is that the plan is viewed as if it was never in existence. In other words, all the deductions that have taken place in the past, null and void. Assets in the plan becomes taxable. So that's the repercussion of a plan being disqualified. Right? It's actually grave tax consequences. All right, last question. It's 12:13. Is there a scenario where the asset does not have to be sold by their heirs? Yeah, the heirs doesn't want to sell the property. Absolutely. But if they have a required minimum distribution, well, then hopefully there's enough cash, or they always have the option of just paying the 50% penalty if there's a required minimum distribution. So in other words, do you have to do anything to satisfy a required minimum distribution by selling the property? You don't have to, but you will incur a penalty. Again, it's either take the distribution or incur the penalty. So if there's not enough assets, you can either, again, sell the asset to satisfy the RMD or just pay the penalty. The IRS form, by the way, that is used by taxpayers to pay the penalty is what we call the IRS Form 5329. The IRS Form 5329 can be acquired for free through the IRS website, www.irs.gov, and I believe it's Part 9 of that form that needs to be completed to pay the 50% penalty. So again, the options are, if you have an RMD, well, either take the distribution or pay the penalty. Well, that's all the time we have for today, folks. Again, my name is John Paul Ruiz, Director of Professional Development here at the Entrust Group. We hope that this webinar was enlightening for you. That was the word I was looking for. I don't even know if that's the appropriate word for it, but anyway, thank you again for attending today. If you have any other topics that you would like for us to cover, please feel free to send us any topics that you want us to cover, and we'll see if we can come up with a webinar for you. Again, my name is John Paul Ruiz, Director of Professional Development here at the Entrust Group. Thank you for attending today's webinar, and we look forward to having you again in another Entrust Group educational webinar. Have a great day.